Welcome to Nasdaq TradeTalks, where we meet the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Andy Baehr, Head of Product and Research at CoinDesk Indices, Tom Warner, Head of Blockchain Business Development at DoubleZero, and Vincent Kadar, CEO of Polymath. We're here to discuss growing adoption signals and scaling crypto into a global financial system. It's great to have all of you with us, as always. And Andy, speaking of growing adoption, a lot of news out of your end of the digital asset ecosystem.
Well, yeah, we were delighted to announce this morning that our parent company, Bullish, received its DFS license its BIT license from the New York DFS, which was a very important, crucial step in being able to provide Bullish services to New York, the most important state, at least in my view, for financial services. So that's great in Bullish's long-standing mission to get permission as many places as possible and serve investors. And that is just continues a good stream of both regulatory and market news. The market has been super good. We were talking a little bit before the segment about how rotation out of Bitcoin through Ethereum through the sort of second into the third quarter, and now over the last month into Solana, is remarkable in terms of performance, in terms of investment flows, which denotes basically a furthering of education, of understanding that things like tokenized things and stable coins are going to need layer one blockchains to operate on. So we're delighted as an indexer and right, for the purveyors of things like CoinDesk 5 and CoinDesk 20, that breadth in performance is alive. Correlations are going down a little bit, and owning the index becomes a smarter and smarter way to allocate to the asset class.
Yeah, especially as infrastructure continues to mature and get more efficient. Tom, you're in a unique place within the digital asset ecosystem. Tell us more about the company.
Yeah, absolutely. DoubleZero offers high-performance networking for blockchains, purpose-built for blockchains. For the audience of this program, it may look most similar to sort of high-frequency trading in the equity space. Equities markets have perfected sort of predictability on trading, not on price, but rather on execution timing, latency, all the way down to sort of the nanosecond as far as how long transactions take. When you compare that to the current state of the crypto market, it's quite unpredictable. From how long it takes a transaction to get to the destination, the latency that's there. This is because crypto traffic up until DoubleZero was fully dependent on the public internet. Meaning when you submitted a transaction, whether on Solana or any other network, that transaction traversed the public internet to get to the validator that ultimately finalized it. What DoubleZero provides is direct links between data centers stitched together to create an alternative to the public internet. What this means is a purpose-built internet network for crypto, and it's our belief that through a network that only supports crypto traffic, you can raise the ceiling of what is possible on a blockchain. Higher transactions, higher throughput, lower cost, to support initiatives like tokenization, like spot holding of tokens, or even going as far as kind of coming up with new use cases that don't exist yet.
Yeah, and tell us about, Vincent, tell us about Polymath and your use case within the ecosystem.
So we're a software infrastructure play. We've been around since 2017. We've always been focused on this sector, building software, building the plumbing, and building the foundation. So we have our own layer one that we launched in October of 2021 called Polymesh. It's been operational since that time frame. We've acquired that asset back, and it is now a for-profit subsidiary of Polymath, and we're taking the company public. So by the end of this year, we'll be trading, and we're raising funding right now to close our round of funding towards the end of this fall, and we'll be listed and trading before the end of this year as well. So pretty exciting, but it's a bit of a nail biter.
Yes, well, it certainly is for of course, any company to go public. But I think, again, that goes back to the growth in institutional adoption, where we've seen a significant amount of digital asset-related companies go, into the public marketplace and access that, which I think is interesting.
Yep, that's right. And I think we will be the first layer one to go public.
Right.
And by doing so, we're raising the level of confidence, what we feel in the network, of what it means to be a layer one. So now the public markets have visibility into the governance, and transparency, and the financial reporting of not just the Topco company, but the subsidiary as well, the Web3 company that's actually going public.
Yeah, it's almost like double transparency.
That's right.
You should change the name of the show to Jill and Three Plumbers. The sign that there are more plumbers in the business and there's demand for that means that the initial rails of relying on the internet and relying on public blockchains, that nuance is going to be discovered. That a little bit more is needed for perfection. And I love actually reading up on your company how everything from validator nodes to tokenization engines are just going to demand, it's a Flash Boys moment, right? Flash Boys moment for blockchain. And the same with, there was a great couple of articles over the last couple of weeks with heated debates about whether things like stablecoins should be on public immutable blockchains or whether there should be recourse or regulatory recourse or things like that. So these issues are coming up, and having the right plumbing solutions handy is really going to help institutionalize things further and let more institutions with constraints participate.
What would be the advantage or disadvantage of stablecoin adopting one form or the other, as you just mentioned?
In one of the podcasts and articles I was reading about is if something goes wrong, right, and a stablecoin, either smart contract itself gets hacked and shuts down all of DeFi, should you be able to go back and take back those trades from that blockchain, or is that blockchain encased forever with those mistakes in it? And so it's basically like a disaster recovery kind of mode that would be so catastrophic as stablecoins become more and more integrated. Should we trust public blockchains to do it, and is that the real source of truth, or should there be recourse at the blockchain level? So not an answer, but just a great thing to follow. And there's certainly it's a matter of if, it's a matter of when, not if. Crowd out there, which is bringing up that question. You're nodding. I see that.
Yeah.
No answers, but plenty of questions there.
You look at how blockchains launched over the last few years, and I think decentralization is a scale, right? If you look at the early launches of protocols, going back to Bitcoin and even sort of Ethereum's launch, you saw these fully decentralized systems. And when you go that far from a decentralization standpoint, you sacrifice some networking. How do these nodes all the way across the globe talk to each other in a consistent manner? And what we're seeing as a trend is more of these sort of permission sets with the plans to decentralize. But to your point around Polymesh and your business, right? Does it make sense to have a fully sort of decentralized permissionless validator set if your use case is serving a more corporate audience? I think we're going to see both sides of this play out.
Yeah, I think that would be a real challenge for further continued institutional adoption. I mean, I would think perhaps the regulators might provide an answer to that, or
yeah, I do think so. I think when we approached the problem space several years ago, we felt the market needed a public permission chain for securities, full stop. Right? We went even a little bit farther to say, well, all validators on our network or on the Polymesh network need to be financial services entities. They need to hold a license in order to operate on the network, right? Because again, we're trying to build a network of trust. We want people to utilize the chain. We want institutions to utilize it. Well, who's going to utilize a chain if I don't really know that entity that's operating that validator on the network? Everybody should be known in some way or another, and everybody should have to report to a regulator at some point. So you're a broker dealer, you're an exchange, you're a bank, you're an insurance company. You hold a financial services license in order to operate on our network.
Yeah, I can't imagine not understanding your counterparty risk. I mean, it just seems.
Who are you trading against, who are you lending to, who are you borrowing against, and who can see your flows too. I mean, some of the other semi-private networks also solve the problem of, hey, if I post collateral on an OTC transaction and that appears on a public blockchain, everybody can see it and they kind of know which way I'm trading. So there's the sort of violent transparency and violent permissionlessness will run into some barricades when it comes into real world use cases.
Yeah, so it's almost like with traditional trading, you have multiple routes.
Of course.
That you can select for a number of reasons. Do you have to have only one blockchain, or think of it in terms of routes?
I mean, it's a good question. I view blockchains use case based, but I do think it is a winner take most in terms of a liquidity market. You had mentioned an interesting topic around decentralization. So kind of going further out on the spectrum, if you look at a network like Solana, manages 2,000 validators, give or take. But those validators, despite being decentralized by an operator standpoint, are pretty centralized from a location, like where they're physically located. So when you put yourself in the mind of a validator operator, you have a choice to either pick profitability over decentralization. You're going to pick profitability every time. And on proof of stake networks, profitability correlates to your networking. I mean, how good is the internet that device is plugged into? And this is why you see not just on Solana, but a ton of networks where the stake weight, the aggregate amount of staked tokens is concentrated either in Northern Europe or North America. And really that's what we're looking to do at DoubleZero, is sort of put more dots on the map as where validators or nodes for any blockchain can run in a performant basis. So you're no longer sacrificing network performance to become a bit more decentralized.
It's really that nuanced where it will impact
Absolutely. So it's kind of, the example I give is, imagine you finish a transaction in a store and all the shoppers need to hear about what's happening. Your proximity to that checkout lane lets you know what was purchased recently. So when you talk about price discovery or trading on chain, your proximity to a validator will directly impact your freshness.
Is this just a co-location issue?
Well, that's the thing, right? So you have a decentralized system that's kind of following co-location patterns. So is it decentralized? That's the area and problem space we're playing in currently, which is how do you give networking options to a decentralized system?
I love the validator example because it's so interesting and tangible and conceivable to think of a validator trying to put blocks together and have access to the latest transactions so they can optimize block creation. And if co-location helps them do that better, that's not good, right?
Yeah, exactly.
And I think we were also talking before the segment about how more use cases for validators, more use cases for staking is about to be unleashed when more investment products will include staking yields. Right now, the vast majority of staking yields are used to enhance collateral, which is a very narrow use case. Right. Hopefully with ETFs allowing staking yields or other investment products taking advantage of staking yields, having them properly priced into the forwards of those tokens, that should bring in a lot of new interest to validators. It should certainly increase the need to benchmark validating results.
Sure.
Right? Because there are going to be expectations. It's not just you get what you get and you don't get upset, right? You're going to require more and you're going to be held to standards as to require more. That's why we create benchmarks for staking yields for exactly this purpose. Yeah. If that requires a co-location solution, that's going to put some people in some regions at a disadvantage, I imagine.
Yeah, well, the co-location requirement is a requirement if you use the public internet.
Right.
Right, so when we think about benchmarking and kind of beating the average, the best example is like a digital asset treasury, right? If you look at a DAT, the lifeblood of a DAT is their ability to acquire assets at a marginal discount to the market. When you're building a DAT, you have two options to kind of acquire those tokens or acquire that yield. The first is through OTC or special dealings or big blocks, and that can satisfy your kind of initial deposits, but it's not a sustainable method for a DAT to continually get a discount on tokens there. We view staking rewards and the benchmarks that you said, if you can run a performant validator set that is consistently beating that benchmark, you're essentially getting access to discounted capital back in the native token. Whether it's an ETF or whether it's a DAT or another financial vehicle, that's where we see the edge.
That's what I was going to ask what the difference was. Rather than having to reinvent the wheel, why not just do it through DATs versus ETFs? Because Andy, you made the point off camera before too, whether it's staking, whether it's even just traditional dividend ETFs, the dynamic nature of it makes it more complex.
Totally, and the value proposition for DATs is exactly that it's not necessarily an asset manager, but it is a treasury manager who is optimizing the performance of that treasury, and skilled people doing that in every way possible, whether it's grabbing 10 or 15 basis points from a staking yield or getting better loan yield on assets. This is what presumably you're going to be paying these folks for, as there will be tons of ways to access digital assets, and tokenization is going to be an important one.
Absolutely.
DATs will be another one. Native will be another one with the new harmonized regulatory rules, and of course ETFs. So DATs really have to stand out as offering, I don't want to call it alpha because that's an asset management term, but enhanced performance based on the quality and the skill of the treasurers.
Yeah, it seems like tokenization is the more natural next step and not quite as nuanced as some of these other ideas we've been discussing.
Well, it's definitely been around for a long time. It's been a narrative for a long time. I'd say the floodgates opened up in March of this year when we started to see the roundtables, the discussions, the White House working groups as well. And so I'd say that the I wouldn't say the gloves are off, but everybody's got their, their name in the ring right now, including Nasdaq, which, again, stated that they wanted all of their securities running, via tokenization in the future. So Robinhood, Kraken, Coinbase, us, right? But we're purely infrastructure. We're the white labeled solution or the Shopify for capital markets, right? Nobody's going to really know that we're operating in the back of the scenes, but we are the players here.
Yeah.
This is the transcontinental railroad. On one side, you have native tokens trying to get into ETFs so that people can trade them easier, and now you'll have equities being tokenized so people can trade them easier, right?
Yeah.
And that meeting will be basically perfect fluidity as to access and alpha appreciation versus fees, and 24/7, and on-chain versus off-chain. It's really an exciting time, and it's rare in a time of non-post-crisis American economic history that you have so much regulatory progress to allow this stuff to happen. To have this progress happen in good times, not looking back at a disaster,
Right.
a quarter mile back,
Yeah.
is an amazing, I think is unprecedented how much progress, how much intelligent progress is being made. So all of these things can happen without any negative surprises.
Yeah. I'm sorry, go
Oh
ahead.
yeah, I was just going to add, I'm excited for the on-chain activities that tokenization provides. Right, at its core, we're taking equity assets and sort of applying the benefits of crypto systems, from liquidity, from trade access. But I'd love to see companies tokenizing their stock, also moving some of their business operations on-chain. Whether that is the issuance of dividends over a crypto rail, governance votes on the stock itself could be quite interesting, all the way down to sort of cost savings at a business level. If you're open to tokenizing your stock, maybe you're open to paying vendors on-chain, saving on cross-border payments, those types of things. But to your point, having legislation proactively and not the result of some catastrophic failure is a very nice feeling in this industry.
I don't remember it ever happening before.
Yeah.
Yeah.
With short-term memory, I mean, just think about the environment. GFC is what you're alluding to.
Right.
To now, it's nice to do something proactively,
Yes.
and not from a reactive crisis. I guess my concern would be: are we trying to create solutions where a problem or the demand isn't there? Like, we're first understanding tokenization. Now we're talking about all these other exotic types of products. Kind of want to make sure you can run before, you can walk before you can run, and
Yeah.
insert more complexity into it.
Well, what I'll say is, in the current state, I don't know that the blockchain systems years ago could support even the narrative here, right? We kind of see this constant push and pull between software optimization and hardware underneath. I can't comment necessarily if there's enough demand of folks who are tokenizing their companies to pay. I wish they would. But what I can say is, from a software optimization standpoint, what's possible now on a blockchain wasn't possible 2 or 3 years ago from a throughput standpoint. But in some ways, these are Ferraris, can go super fast, can do amazing things on the transaction side, but those cars are stuck on a dirt road when it comes to connectivity, right? When you are sharing sort of packet space on an internet network with somebody streaming on TikTok or watching Netflix, you can never create a market as efficient as a capital market that exists. So that's sort of the piece that we are here to help solve for, is if you have all of this software, all this tokenization, optimization, is there a set of plumbing and infrastructure network underneath that can truly blow the lid off of what's possible?
Yeah. So Andy, that sounds like, okay, we saw product rollout, we saw regulatory framework get executed on, and now it seems as if the infrastructure refinement is really where the conversation's leading to.
And the demand, I think, is going to come from, oh, that was cool, I want to be able to do that too, right? If you have a tokenized stock that issues a dividend on chain, you're going to think, well, why are we not doing it that way all the time? And I think these things will become self-propelling at some point. The velocity right now is going to help that happen sooner. We had a long drought, many years. I mean, we were saying on this show a year ago that, where is DeFi and where is blockchain solutions? We're disappointed that we haven't really heard anything yet. And now we're really starting to hear tangible things and real concrete progress. So it's a very exciting time. We need the economy to hold up. We need demand to hold up. I guess we need the IPO market to hold up.
Yeah.
I think we do, yeah. Well, and I think what we're like, there's a lot of similarities in the DeFi and the blockchain space in crypto as to the first wave of the internet. The first wave of the internet, if you remember it back in 1998 to 2000, there was the build up, and this happens in every segment, right? There's the massive build up, and then the massive blowout, right? And we already had the blowout, right, in the crypto community. Now the real businesses are starting to form actually out of, I guess, the ashes or the learnings of that, that first wave. So we're here now, and it's good to see that at least there's clarity in the regulatory framework, because I think that was the biggest issue. There's so much speculation around that wasn't clear enough that nobody wanted to tip their toe in the water at all.
All right, we'll leave it on a positive note, guys. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.